I get it. When you think of options, you don't exactly think of the safest investments ever because they just don't seem like it. But what if I told you there was a way to not only use options to save money, but also increase your overall portfolio return? You can do this through the wheel method, verticals, or keep it pretty safe by protecting your portfolio with options. Welcome back to the channel. I'm Jacob Fisher, and today we're talking about how to use options to protect or grow your portfolio. I'm not an investment professional though, so this video is for entertainment purposes only. I do have other videos on generating weekly income that you can check out in the corner. So this video is not for that specifically. You can check that video out if you want to see that, but rather to incorporate options into your general portfolio or even your retirement portfolio so you can protect your portfolio and potentially increase the gains it makes every year just by a little bit. Let me ask you this. If you get a little bit into the video and you realize you like this video, then go ahead and tap that like button for me. It really helps things out at the end of the day. And with that said, let's get into it. I wanted to go over 2 ways that you can use options in your everyday portfolio. Your portfolio with your retirement account or the one you use for dividend investing. There are 2 strategies out there that I think are most beneficial to the average person. And these strategies are that I have used in the past. And the first one is to secure your account with options. I've talked about this in another video in a bit more depth, but the rough idea is to purchase puts on your overall account when things are not looking so good in the stock market. Let's say the market drops 5% and the economy or the stocks are just not doing well and you think it's going to drop even further. What you can do is look at your portfolio and decide what kind of stocks are you invested in. If you have a tech-centric portfolio and tech is down a ton, then you can consider choosing ETF as QQQ and buy puts on that. QQQ is a tech-focused ETF or an ETF with the largest NASDAQ 100 stocks, which does happen to be a lot of tech stocks. If you have a portfolio based on the overall market, then consider SPY as the ETF of choice in this case. Let's use QQQ in this first example. You want to stop the bleeding going on in your portfolio, and all you need to do is buy QQQ puts. But how many, you ask? You need to purchase enough QQQ puts, that's so weird to say, QQQ, to secure your portfolio. An option contract is worth 100 shares of the underlying security. So if you were to purchase a single put on QQQ, that would give you the right to sell 100 shares of QQQ or the underlying security at the price you chose. A $300 put or $300 strike price put gives you the right to sell 100 shares of QQQ at $300, which is about $30,000 in value. Let's use a $100,000 portfolio in our example. Your $100,000 portfolio is down 5% and it's worth $95,000 right now. You divide the portfolio value by the price of QQQ. So 95 by 300 is 316, and then you divide it again by 100 because of those 100 shares per contract. In this situation, you would need to purchase 3 puts, which is not very many, to provide just a little bit of insurance on your portfolio. Let's say you think the market will drop 5% more, and you want to be secured in this example for more than 10%. You're comfortable with your portfolio being down 10%. That doesn't bother you. That's when you start to get worried though, is when it drops after 10%. You can buy 3 puts for QQQ at 5% lower than the price it is because QQQ is at 300. That's a current price of 285. Maybe you want it to be secured for 2 months out because you think it's going to drop pretty heavily over the next couple months. So February 19th, 2021 expiration, and the 285 puts can be bought for $8.67 per contract or $867 per contract because you do multiply contract prices by 100 because of the 100 underlying shares gives you the right to purchase. With 3 contracts, that's $2,601 total for insurance if QQQ drops below 285. Let's say the market has a severe downturn and QQQ ends up at 270 by February 19th. That means your contracts would be worth at least $15 per contract or $1,500 each. Your portfolio would be down an additional 10% to what we previously mentioned, so it would be worth $85,000, $500, but your contracts are worth $4,500 at the minimum, while you paid $2,601, that $4,500 does help a bit, leaving your portfolio with an overall value of $87,400 rather than the $85,500 you originally had. Every dollar that QQQ continues to drop below 285 or 270, whatever price it is, your option contracts would approximately increase $100 in value. If you thought QQQ would drop sooner, you don't need to purchase 2-month out contracts. You can purchase 1-month out contracts for much cheaper. They'd be about half the price, and if QQQ dropped again to that 270 level, they would all be worth about the same $4,500, except you've paid half of that to protect your portfolio. This is a way to protect your portfolio in market downturns. The further away from the current price of the ETF you chose, the cheaper the contracts will be, as well as the closer the expiration, so closer expiration date, and further out or out of the money, the cheaper the contracts will be. If you think in the next month that the market's just going to collapse and you buy really far out but really close expiration puts, they could be super cheap and provide you with a bit of insurance just for a couple $100, let's say. This can be super helpful in protecting your portfolio from market downturns. The other example is to buy calls on stocks you think will do well. You could take SPY in this example for an overall look at your portfolio if you are in the overall market in the S&P 500. SPY is an ETF that looks at the overall S&P 500 and increases on average 13% a year. That's pretty good. So in theory, you could choose options a year out about a 13% increase in the price. 13% higher for SPY next December is $413 a share. That seems insane to think about that SPY is going to hit that, or potentially could hit that. But on average, this is what happens. The December 2021 415 calls for SPY, because you can't buy 413 calls for it right now. You have to buy $5 increments. They're trading at 7.5 a contract right now. What that really means, though, is that SPY needs to be 7.5 above 413 or 420. Nice. Which isn't super likely, but you really wouldn't be holding these until expiration. Well, what you'd want to do is when you're up 50% or so before the options expire, it could happen in 6 months, it could happen in 3, it could happen in 9, but you want to sell your contracts when you're up a bit, maybe 50%. Ideally, you don't let these expire, because SPY would need to increase a little bit over that 13%, and that's less likely than it just increasing 13%. You want to sell these contracts for a bit of a win while they still have a bunch of time left on them. If you wait about 6 months and SPY increases maybe 5%, then your option contract should also increase in price. Options are a little fickle and based off of a number of factors. Number one would be the distance to the current price. Other one is length of time until expiration. And then the last one, well, one of the last ones I'll mention is the overall volatility of the market. Those are kind of the largest influencers when it comes to the price of an option. At 6 months out, closer to the price with decent volatility, then your options should be up maybe 10 to 50%, potentially even 100. You never really know with options in that time. It wouldn't be the worst idea to sell those options for 10 to 50% gain and call it a day. If you use the same rule to decide how many calls to buy as we did in the last example, you'd purchase 3 calls for 7.5 and spend about $22.50, and at the end of 6 months, you'd expect the contracts to be worth maybe $29.25, which is a small $700 gain for your $100,000 portfolio, but still something to consider. It would be money you didn't have before. And of course, you can always go bigger. The options could also be worth $1,000 or more, or SPY could increase so much that you're in the money super early on, which would provide you with, an insane option valuation. This is just a small way to increase your portfolio slowly but surely. You can do this with individual stocks as well. Maybe you think AMD will increase 20% in the next year, so you purchase the 110 calls, and then AMD goes up to 150. Those calls would be worth at least $40 a contract or $4,000 a contract, leading you to some good money that you could potentially make on this, just because you'd put a little bet on AMD thinking it would go higher and it just happened to go really high. The idea with options is, though, that you don't use your whole portfolio and make decently smart plays on stocks. Try not to use more than 10% of your overall portfolio in options, because options are worth so much when compared to everything else. They are 100x the strike price, so a $300 strike option is worth $30,000 of the underlying security. These are just small ways you could potentially use to increase your portfolio value or protect your portfolio value when the market kind of goes down. With a tiny portfolio, use smaller amounts of option contracts so you can first get used to the idea of using options to increase or save your portfolio from market drops. If the market is going up, you don't really need to buy puts to protect your portfolio, but rather buy calls because stocks only go up, right? Most of the time they do actually go up. So just remember, the further out you go and the further away from price, the higher the option contract price will be. Let me know your thoughts on this in the comments below, and if you would use options in your everyday portfolio. I upload videos on Monday, Wednesday, and Friday on travel and finance, so if that sounds like something interesting to you, make sure you hit that little subscribe button down there. Thank you so much for watching. Until next time.